On today's Positively Sloped, Scott Bauer, CEO of T3 Prosper, joins me in the studio for a wrap-up of Q1 before we move on to the war in Iran and the latest updates and how that's affecting oil and possible inflation prints on Friday, and then wrap up with some Masters talk. Okay, let's talk shop. Today is Wednesday, April 8th, and welcome to Positively Sloped. Dad, welcome back. Welcome to the studio, a place that you might not be familiar with. Have you ever been on the floor of this area?
What is this out
this
here?
Is the Cboe floor right here. One of the last open outcry pits in the country. Have you ever seen anything like this?
I have wanted to see this for the longest time.
Yeah.
It's probably been about a day or so since I was down here. And for those of you that don't know, the S&P 500 pit, which is right here, I actually traded in there for a very long time.
Very long time. So familiar digs for you, at least.
Familiar digs. Love it. Home away from home.
Yeah, absolutely. We've got, as always these days, a lot to cover. I want to start today by revisiting our fades or trades from a couple weeks ago when we did Positively Sloped from the slopes before we got about an hour of skiing before 70 degrees.
I think I got the under
on
that.
Real quick though, we'll just hit on these and then we'll move through to today. I've got a show flow. I want to review Q1 and then get to the current events and then talk about what's going on in the future.
Do we have like 3 weeks for this?
Yeah, we've got an hour. We got 3 hours for the listeners.
Excellent.
But we'll just blow through the fades or trades from a couple weeks ago. So we said fade or trade, the market will have given back all of Monday at the time, March 23rd's gains through the rest of the week. We both faded that. We were both wrong. Thursday and Friday, the 26th and 27th were consecutive 1+% down days. This trend that we've seen that we talked about and we both acknowledged of Monday up and then the rest of the week down as the war progresses happened again. We were both wrong on that. We'll get to why we're reviewing these in a second. But second one was WTI and Brent trade above $120 a barrel again in the next 2 weeks. I traded that. You faded that. They've been around that
No.
number.
117 top in WTI.
Top. So they've been around that. I do want to talk about, and you kind of teased it right there, this weird kind of dynamic of WTI trading above Brent.
Yeah.
We'll get to that in a little bit.
All right.
So far, so good on that one. The third one was the Fed makes a move in April. We haven't had that yet. That'll be next week's Fed meeting. And then the last one was a 1 seed wins March Madness. I traded that. I don't know what you did. The point of this was to say that I had Michigan since mid-January on this podcast. Said it again, doubled down, tripled down last week or 2 weeks ago, and they dominated that tournament.
You know, Indiana's not a basketball school anymore. Illinois maybe is. We had a
nice tournament.
We had a good tournament. Good tournament. Didn't really want to see either of those teams win, but is what it is.
Yeah. It was a great tournament.
Yes.
Michigan was the best team the whole time and took it home.
Were.
So that's our March Madness wrap up real quick, but let's wrap up Q1 for the market. So we had all indices were firmly lower. Pretty lucky or not lucky, I'll let you weigh in on this in a couple minutes on how bad the end of the quarter was, with that March 31st day being a plus 2.5%, 3% day for all major indices. So stopped some of the bleeding. You had the NASDAQ was down 10% year to date headed into that day, and then rallied up 3% to finish down 7%. So A, is that a coincidental relief rally? And B, what does that do for traders? What does that do for market sentiment for the people on the pit, for traders online?
Well, I'll tell you right here that the traders down here, because I'm down on the floor almost every single day, they never really bought into a major sell-off. And I think the reason is because of what we saw happen with the VIX, what we saw happen with volatility. Yeah, we hit that 30 level on the VIX just for a brief moment a couple of times. The opportunity, though, to have protection, whether it was for traders on the floor here, for retail, institutional, was abundant. So I think people were already positioned for a potential downside, which allowed them to be more aggressive with their trading. So, was it a coincidence on March 31st that we got a lot back to make the quarter not look so bad? It may have been a little bit of window dressing there, something to consider. But I think all in all, given everything the market has been through, the shock of, Middle East, everything, I think the market has held in pretty well.
I would agree. And you mentioned the VIX and having it at 30 for just a brief moment. The VIX tends to protrude a 1% move in the markets for every 16 points in the
exactly.
VIX. So you had the VIX at 30. The market moved about 3%. We've seen the VIX elevated relative to historical norms over the last 3, 4, 5 months. And that has been, we've also become accustomed to these 2% days, these 2.5% days. An interesting part about these days that I want to talk about is a lot of this movement is happening overnight.
Yeah.
And we're gapping up and we're gapping down. And then intraday, there's not a ton of activity. So this is a little bit off the script here. But, when I think about trading, all movement is good movement. It's all opportunity, whether it's up or down. You just, you kind of got to point direction and then figure out magnitude. But when a lot of that activity happens overnight, what's the opportunity throughout the day? If, take today, for example, we gap up 2.5% on the news that we've got a 2-week ceasefire. We'll see how that news, rumor, whatever you want to call it. If we stay at these levels the rest of the day, is there a ton of activity to be had?
I think that's the key. Are we going to stay at these levels, and where are we going to close? Are we going to close near the highs of the day, or are we going to sell off a little bit? Right now, it's not so busy down here, and you've talked about that. And I think even though option volume has been busy, has been robust overall, the activity intraday really hasn't been, because like you said, we've seen those gaps. We haven't seen big moves during the day. So it allows professional traders, it allows retail also to really digest what has happened overnight and then to take an opinion. And that opinion maybe is not just for the day, because we haven't seen a lot of big intraday moves, but it allows you to take an opinion for the next tweet or the next news cycle that comes out.
Yeah, for sure. And let's digest what Q1 really looked like overall, not the intraday, not the intra-week trading and all the rumors. So the real backdrop is, the objective backdrop is, we had strong and resilient corporate earnings again. We had double-digit growth, beat expectations in terms of the S&P as a whole, led by the Mag 7, but really there was some strong earnings across sectors.
Across the sector.
We had largely positive, but variable job numbers. We'll talk about that March surprise upside print to offset the February down print, but overall, pretty solid. Inflation is nagging, and that's going to be a topic we'll get to in a little. So that provides you a downside. And then you've got, just throughout the quarter, since really late January when this conflict started, or late February, I should say, all eyes on Iran and what's going to happen there. So there's a lot of reason for positivity and for bullishness in the market. You've got this one huge event, this one huge conflict weighing down on everything, but largely, you said it, the market held up pretty well, all things considered. How do you take in the first quarter? What do you make of it?
Well, I think this has proven that if you remove everything else, the bond market leads the equity market. There is no question about it. The bond market was flashing some signals, and once we saw the 10-year drop below 4%, that was kind of a high water mark in the equities. And as things started to escalate, and as credit started tightening, and as inflation started picking up, and we started to see that 10-year ratchet up towards 440, almost 450 again, that's where the equity market got in trouble. So going forward from here, yes, we all hope the de-escalation holds. The bond market and rates are going to drive this market here. The equity market is very comfortable right now with a 4 to 4.5% 10-year. Okay, if we start to break above that 4.5%, the equity market could start selling off again. If we start to see rates coming down again, that should be bullish for the overall market.
And even, you saw this Tuesday night as we were approaching Trump's deadline, where we got the news at 6:30 or so Central Time, or 5:30 or so Central Time, that there's been negotiations and there's a 2-week extension. But before we got that massive soar in the equity markets, the bond market dropped a little bit. The bond market was telling us that we feel okay with what's going on. We feel okay with the news. And so bond rates were down a little bit. And that's that point about leading the equity markets. We've talked about this. Bond market is however X bigger than the equity markets. Exactly. They're always going to lead.
No question about it. And I want to kind of jump back for a second. You mentioned earnings. earnings start again in earnest next week. There have been so many upgrades in terms of what guidance is. I was reading something yesterday that this could be like the largest set of upgrades. The expectations are actually pretty high for earnings coming up right now. And I don't think that would be the case if the market really thought that we were going to see rates stay elevated at these levels.
It's this disparity of which news item or data point is first and foremost in the market's trading. We talked about bond markets leading the equity markets. Within the equity markets, a trend that we saw in Q1 was the rotation continued. And we saw this at the end of last year. Obviously, you'd expect energy to lead in this market, given the circumstances overseas and the fallout that could happen with that. But we had pretty broad participation in the market outside of tech. For a down market, what you'd expect is the defensive sectors rotate into power, and that's what happened. It was led by energy, materials, utilities, real estate, you name it. Pretty textbook, and there was less reliance on AI and mega caps.
No doubt, and that's healthy for the long term, outlook of the market. There's no question about it. You look at some of the Mag 7, some of the big tech stocks that, you see some of these valuations now, some of these PE ratios that are just about as cheap as they have ever been. And if I had that crystal ball, which I don't, but if I could close my eyes and say, boy, 9 months from now, a year from now, are these things going to be higher or lower? I'd close my eyes and I'd pretty much buy all of them.
It's pretty. I mean, I was talking to some clients yesterday about the valuation gap between international and domestic closing. There's certainly some valuation tightening between, growth and value right now.
No doubt. And
go ahead.
I was going to say one other thing that really held up that I still like, even if we start expanding, is some of the consumer staples. Not discretionary, but if you look at the big retailers, Costco, Walmart, boy, those things held in so strong. And I think those are set to really launch even higher, regardless of what the economy does.
I like that. And I mean, that aligns you. We're going to get to it in a little bit, but consumer sentiment is down in the dumps, pretty much at an all-time lows. And that does lead people to pull back and tighten their spending a little bit, go to Walmart, Costco, and buy some of those goods. If I asked you who were the top detractors from the S&P performance this year, who would you say?
Individual stocks?
Yeah, individual stocks.
Had to be NVIDIA. No, probably not. It may have been.
Go ahead.
You were saying year to date.
Yeah.
Year to date.
For Q1.
Yeah, NVIDIA, not Apple, maybe some of the cyber security stocks. Boy, you're putting me on the spot here. Microsoft for sure has to be up there. Maybe even Meta.
So the top 8 detractors, keep in mind, this is based on their cap weighting too. So not the worst 8 performers, but the top 8 detractors were Microsoft, NVIDIA, Apple, Amazon, Tesla, Meta, Broadcom, Google.
There you go.
Your new Mag 8 with Broadcom involved in that. I mean, those 8, again, not the worst magnitude performers, but given their size and weightings in the S&P, the top 8 detractors from performance.
So I think that there's something to be said about that these 8 stocks who have carried the market for years, let's call it, those are the worst performing stocks. And yet, we had a sell-off, but we're still within, reach of all-time highs. And that goes to the broadening of what we've seen. And again, I think that's super healthy for the markets down the road.
For sure. I mean, we are, as of recording right now on Wednesday, we are less than 1% away from positive year to date in the S&P. And we were down 8% 6 days ago. You remember like 5 or 6 years ago when I was a senior in college and then fresh out of college, and I would write articles for you?
I do.
And I think I wrote articles about the Santa Claus rally, the Super Bowl theory.
Don't tell anybody that I really didn't author those.
The one that we write about and we talk about it at Kingsview and is very, very persistent, and because it happens every single year and every 4 years, is the presidential cycle. You follow the presidential cycle closely as a trader?
As a day trader, absolutely not.
Sure.
If I'm looking to position, longer term portfolio, maybe. I think it is, it's somewhat irrelevant. It's one of those data points. It's one of those things you can look back and say, oh yeah, it held again. I'm really not thinking about it on a day-to-day basis.
So it's more of a confirmation bias when it happens. And
for sure.
So that's interesting because, I wanted to take this and say all these things that happen throughout the day, right? The different data points, the different company news, the every conflict going on in the world, whoever wins the Super Bowl in March Madness, it changes every year. It changes every quarter. But one thing that held true, and whether it's confirmation bias or not, was we wrote this in our 2026 outlook at the start of the year. The second year of a second-term president, the midterm year, is typically the weakest of the 8-year possible cycle. And this was always going to be some sort of difference because it's obviously a disconnected second term for President Trump. But it held strong in the fact that typically that first quarter, you see some momentum at the start of the quarter coming off from the last year, and then it wanes into March and April, into the summer, and then we get a positive Q4 to rally back. And what we saw was all-time highs around January 28th, February 2nd, and then obviously my question is, you could say it's circumstantial based on the war, but again, this is a long-standing trend of 70 years of the S&P, and it tends to point in this direction. So you're saying it's really coincidental. You don't really take much from it, but is there anything to derive from that?
I think that recently, when I say recently, I'm talking about the last couple of years, trends that we have seen in the marketplace that have held for decades and decades and decades haven't necessarily held all the time. And if we look at 2025, right, start at the beginning of the year with Liberation Day, was it a one-off? Probably. It's one of those things. Massive rally back. But if you sold in May and went away, you got handed to you, right? And some of those other trends really didn't hold throughout the year. So I look at this year and say, okay, is it going to be a sell in May and go away? I don't think so. I personally don't. I think that if the Middle East conflict is not going to be over, but if it's minimized, I think this market is set to roar. So as a trader on a day-to-day basis, I am not thinking about that. But on a macro level, I think you do have to look at those data points.
Yeah, it's just again, it's interesting that you could take the day-to-day perspective. You could be so bogged down in headlines and news and what you see on the TV, and depending on which channel you watch, how it's perceived. And if you just step back and take an objective, review of the quarter, you could say, oh, that looked like a lot of other quarters in this given period, and none of this stuff was going on then.
Exactly. So what you're really saying is you have to remove that emotion from your decision making, which in teaching tens of thousands of people how to trade and trading, that's the biggest hurdle for anybody trading. Remove your bias, remove your emotion.
And I mean, that's from a trading perspective, whether it be day trading or week trading or month trading. That's the same perspective we hold as long-term stewards of investment portfolios, is that when you decide, oh my God, the market is so terrible and the war is going to go on forever and this is going to be World War III, I got to pull all my money out. As Scott likes to say, that's when I'm putting all my money in.
Yes.
We too say you have to take your emotion out of it because you make bad decisions.
There's this guy out there that some people may know about, Warren Buffett.
Yeah.
Said the same thing, right? When it goes something like this, when people are most fearful, that's when you need to be greedy. When people are most greedy, that's when you need to be fearful. So I agree with Scott. I agree with Warren Buffett.
Yeah. So you said, the market is set to move higher. Should we get some sort of real or lasting resolution in Iran? And I would agree with that. And it is all eyes on Iran right now. And so, last night, 2 days ago, we had President Trump put out a Truth Social post threatening to wipe out the civilization of Iran, to never return if they don't meet the deadline of 8 p.m. Eastern on Tuesday night, last night as of recording. An hour and a half before that recording, we had news that there were negotiations that were being mediated by a Pakistani and Chinese governments. And obviously, we just mentioned that the market gapped up 2.5%. So the market continues to trade on strictly, basically, news of Iran and Truth Social posts and Easter posts that were swearing in and whatever else is going on. It's a very, very, to bring back a point from 30 seconds ago, emotional market.
It is a very emotional market. It is a tricky market. These swings that we're seeing happen on a minute by minute basis are like anything, nothing we've ever seen before. I would caution, just my own personal conviction here. This is not over. It is not over, right? There's a new 2-week deadline. This is not going to be resolved in 2 weeks. So what does that mean? Does it mean that you fade this rally and just get short everything? No. Does it mean you buy into it because we're moving higher? No. What it means is you've got to stay prudent. You've got to stay nimble. I look at what happened to the VIX today. VIX went from nearly 30 a few days ago, closed at 27 2 days ago, and it's hovering around 20 right now.
Yep.
Historically, 20 is actually a very high number. For this environment, I think that is incredibly, incredibly cheap. So you go out and you say, hey, I want to get a little protection here because I want to, maybe keep some of my longs. I want to initiate some risk. I think VIX at 20 in this environment, way too cheap. The conflict is not going away.
Yeah, I mean, if we expect a resolution in 2 weeks from an American perspective, that means that the Strait has been opened and that Iran has given up all nuclear capabilities. And I don't think they've come this far just to come this far. So I would agree that this conflict is not over. And speaking of cheap, the wild swings in oil. I mean, there are some oil traders that are making millions right now. Probably some oil traders that are losing tens of millions.
Yep.
But we are now back for WTI and Brent back down into the low 90s. Like you said, topped out at 117 a couple days ago when it seemed like we were going to take drastic measures in the bombing of Iran. The point we mentioned at the start of the episode that I am going to turn over completely to you. How is it possible, and this is something that I discussed with Scott at the start of the conflict, I discussed with Neil, we discussed a couple weeks ago, that we've got so much oil in the United States. We just, onboarded Venezuela as a strategic partner. That's probably 2 years away from being operational, it sounds like. But still, with all of our reserves, how is WTI trading above Brent?
So really two reasons. Number one, if you look at our oil here, okay, our oil is not indicative of what we use on a day-by-day basis, right? And I'm not an oil expert, it's the heavy sludge. So even though we have a lot of it, it still takes a very long time to process it into how we use it every day, whether it's in your gas tank, natural gas, whatever it is. So even though we have a glut here, it's not the perfect oil. What people have to remember, though, is this is a global commodity. Okay, this is a global commodity. So just because here in the United States, we may have all we need, and I don't think that is the case, but we may have all we need, it still trades on a global market. So there's still risk. Anyone trading that could be in Asia or anywhere else in the world could look at our markets, have access to it, and, trade it and say it's bullish or say it's bearish. The risk to what happened with WTI getting more expensive with Brent was something called backwardation. Not dissimilar to when we see that happen in the marketplace with volatility or with the VIX, where a near-term future gets more expensive than a further out future. And backwardation, when that happens, which is not something that happens all the time, we usually see a very, very quick reversal out of that. That happened this time. So what the market was kind of telling us, and it's obviously easy to be the Monday morning quarterback and look at it from few days out, but what the market was telling us was there is an immediate risk panic to WTI. And that's why that was getting bid up so much more than Brent. And those that listen to history, we talk about these historical trends, and looked at that backwardation. And if you played the Brent WTI spread, you knocked it out of the park.
So it's a yield curve inversion almost
for sure
for oil.
Absolutely. And it doesn't, when we see those inversions, it does not last long.
Interesting. And I think to the Venezuela point too, I think that's probably not the great success it's been held to be. I mean, you mentioned having all the oil that we need, or probably not. I mean, we use millions of barrels a day. Venezuela is slated to produce 200 to 300,000 barrels a day.
Yeah.
2 years from now. Not sure that that's really solving our today problem, but the oil crisis, it all, like we've talked about, it all hinges on the Strait of Hormuz, which so far no resolution. Did you see the report from Citrini? Did that cross your desk?
Well, I'm sure it did, along with the 17,000 other ones.
This was pretty cool. You would have known this. So Trini Research is a kind of middle of the road research firm on the street. They sent an analyst out there undercover, kind of like what was that Netflix show? Not Night Agent, but the other, like the CIA one.
Oh my God, it's the one you guys have said to watch, and I haven't.
Yeah. Can't think of the name, but they sent an analyst out there undercover, and he reported on what the Strait of Hormuz looks like, and it opened at least my eyes. I don't know what I probably had a movie-esque picture of what it looks like out there, but he's basically like, it's open, it's pay to play. The Irani government is boarding ships. They're asking for documentation. It's pay to play. If you don't pay, it's not like they're bombing that ship. They're just leaving you out there in the sun to bake all day. But it sounds like, like we talked about 2 weeks ago, you said if our multi-billion dollar organizations have to pay $1 million to pass through,
what's the difference?
That's worth it. And it sounds like that's what's happening. It's just moving a little bit slower. But certainly with WTI going above Brent, this has shown, I think, and disproven some people from a month ago that said we're okay because we produce all this oil.
There's no question about it.
We're not insulated from the shock.
Yeah. So, the drill, baby, drill, great, whatever it is. But that does not mean that we are insulated from a global shock like this in any way, shape, or form.
Yeah, exactly. And oil isn't just oil, right? Obviously, it's what's at the gas pump, which is a huge expenditure for most consumers and households, but it also is a part of food, plastics, fertilizer.
You got it.
And that leads us to our CPI print coming on Friday. You said a couple weeks ago when we kind of disagreed on where inflation is, you said, okay, but the March print doesn't really have, or the February print doesn't really have effects from the war yet.
Yep.
There was a Seeking Alpha report that came out that basically said every 10% move up in oil is somewhere around a 25 to 30 basis point move in CPI. So the analysts on the street expect like a very hot print coming out on Friday. Some analysts expecting near 3.15% or so. Do you think it moves that quickly?
Yes, I do, because that shock from the February report to this March report happened so quickly. Now, when we see this print, if it is a super hot print, which I believe it's going to be, there's going to be a lot of caveats in there. There's going to be a lot of parsing out of what happened because of the escalation in the Middle East. So is it going to be market moving? Yes, it probably will be. If someone is set to trade the print, boy, you better be nimble, because you're likely to get a big gap that reverses one way or the other.
Yeah. And there was the New York Fed put out their inflation survey yesterday that showed, and this goes back to consumer sentiment, but households expect inflation to be 3.4% in the next year. They expect to pay more for groceries. They expect a higher chance of losing a job. That might be some AI impacts there. And current perception of their financials has decreased. So again, you've got consumer sentiment, and I'm sure the Michigan survey will back this.
Yep.
Very, very, very low. From an investment perspective, obviously, I understand the pain that households are feeling at the pump and at the grocery store, but from an investment perspective, that has got to align with a turn in the markets.
Contrarian, 100%. That is just like when we see the VIX trading 30 or above, that is typically a turn in the market. It's a buy the market indicator. That is very contrarian, and that goes back to that fact when, or the saying, when people are most fearful, that is the time that you want to be on the opposite side of that. So I get that. I am concerned that even with this drop in oil, and hopefully it's not temporary, hopefully it stays here, we are coming to the most expensive part of the year. This, you look at Memorial Day through Labor Day, typically we see gas prices, X% higher. There's got to be different blends of gas that drives that. People are ramping up, so that concerns me a bit, that if this escalation does continue and prices at the pump don't come down, they're just going to get more and more expensive, and this consumer discretionary area is going to get hit. However, I'd like to be optimistic. I like to be realistic. I don't necessarily see that happening.
Yeah, I mean, we are, on the timeline, we are moving from short-term conflict and something that could be a blip on the radar and data points to intermediate term. I mean, from the start, it was analysts and people were saying if this goes on months, we'll see a pretty intermediate term impact on inflation numbers. Well, we're entering week 7. And so we're getting to that time period that this might last in inflation. And so we'll see on Friday what the real print is. And I think May will be another important number, of course. But we continue to see these data points. And speaking of data points, we had a jobs report last week that we mentioned earlier. Surprise to the upside, which was pretty important. What I thought more so, because February we had a negative print. There was a healthcare strike in California and hospitals that had 35,000 employees that were lost, in that number. And so that strike ended. They got back in the market. I was impressed with January's revision upward. This is something that Neil and I talked about. All revisions lately have been down. Every prior 2 months we've been revising down. We got an upward revision. So the market is gaining 70,000 jobs a month this quarter, which given February's number is pretty robust.
It is, but I think though we had that big blowout number of the upside, didn't we see a revision down?
Yes, even further.
Right.
41,000 more jobs lost.
And I just think that there's too much of a gray area in these reports now to really understand what's happening beneath the surface, whether it's with public sector, private sector. So it's real hard to trade those headlines. But listen, you talk to your friends, you talk to people on the street. I talk to my friends, and jobs out there are not easy to get.
Sure.
I don't care if you're coming out of college or if you're 50 years old looking, to make a career change. It's difficult.
We've been in sort of a no hire zone since last April. We're coming up on a year of a very no hire environment. The show, by the way, is The Recruit that we watched.
There you go.
That's what I was thinking.
There you go.
So we certainly big data point coming on Friday. Then a breath in terms of economic data, but the market continues to move on the Iranian war and what's happening over there, and we'll see what happens over the weekend as we've kind of detailed that trend of a lot of conflict rising up over the weekend when the market's closed. Speaking of weekend though, and I heard this joke, it's tongue in cheek. It's not funny for some people, not others. But if you really thought that Trump was going to wipe out a civilization the night before the Masters, you don't understand his priorities. We've got Masters weekend coming up.
We do.
One of my favorite weekends of the year. I was blessed enough to be invited last year.
Oh man, bucket list.
Pretty incredible opportunity. I'm bummed not to be going this year again. But I'm very excited. I'm very excited to sit down and watch a ton of golf. Anyone you like in the field?
Jack Nicklaus.
Jack Nicklaus. I think you still got Freddie Couples.
I
teeing
do.
It up. VJ Sing's teeing it up.
Yep, they're all there. I mean, it's hard not to go with the big guys.
Yeah.
It's really hard to fade those, and it's not my wheelhouse.
Right.
It really isn't my wheelhouse. But I'm gonna go with John Rahm.
I like that pick. It's gonna be very interesting. There's a lot of storylines coming into this week. We've got, Scotty just had a baby, but he's got a new dad bump, but he's not been playing the best golf. Rory might have a back. We don't say injury. We just
a back.
Colin Morikawa definitely has a back. Bryson and Rahm are playing unbelievably on live right now, and so there's I think it's gonna be a great weekend. It's the first weekend in a handful of years that the weather looks unbelievable.
We've seen some delays recently.
So that'll be interesting. It's going to be a birdie fest, I think, although the greens will probably be quick as hell.
You know what? That you look at the short players, right? And the short game, who is the best short game player? Who's going to get it to the green and get it to within 10, 15 feet? And may come down to that. And John Rahm is my guy.
I like that. Let's get to the fades or trades for the week to wrap up. So we did this a couple weeks ago. You know how it works. First fade or trade. We touched on this, but I'll take your definite answer here. Headline CPI over under 3.16% on Friday.
I'll say over.
Okay. I will. I'm going to trade the under 316. Okay. I just think I not to diminish, the impacts that the oil increases have on inflation. I think it's a little quick. I think what I read at least was that it's going to take a couple more months to fully filter through all that basis point increase. So I'll say for Friday at least we stay under that number.
It's like what's going on here.
Second fade or trade. S&P ends April in positive territory for the year.
I will take that.
Okay.
I will take that. Yes, I say yes.
How come?
I will trade it because I think that the underneath the surface here, yeah, we broke some support. We're back there. I just think that things are actually fairly decent, and earnings that start next week, which we'll be full into it by the end of the month here. I think we're going to see some nice surprises to the upside.
I like that. I hate to be the pessimist of the team here, but I'm going to fade that. I think it would be easy to say we're in a 3% up day. So, you're just looking for 1% more the rest of the month. I don't buy into the 3% up day today. I think the 2-week ceasefire based on historical trends and nothing else will be broken before then, probably on our side. And so I still think there's too much uncertainty there. Like you've said, I don't think it's coming to an end in the next 2 weeks. And I think that's going to weigh on us in April. You already answered this one, so I'll answer this. But fade or trade a 1 seed, and I've got the 1 seeds coming off March Madness as Scheffler, McIlroy, DeChambeau, and Rahm wins the Masters. Your pick is Rahm, which I really like. I'll fade that and take the field. Like I said, Scotty's not on his A game. Rory's got some injuries. Bryson and Rahm are both very, very hot right now. I saw Bryson and Rahm are the 2 biggest ticket getters, though, in the betting markets, which typically, the books don't lose. I think it's going to be Xander. Schauffele. Every year at the Masters, people say X is going to win. He's right for the game. You mentioned iron play and short game. He's an elite iron ball player, and he's a very good putter. We'll see. I'm playing my first round on Friday in New Jersey with your boys Jack and Darren. So.
Big shout out.
So I'll take X in that. This is just a topic. Fade or trade the Artemis 2 mission. Do you care about it? Do you like it? Do you not like it?
I care about it because it's historical. I heard one of the Apollo astronauts talk yesterday saying that this is not life-changing. This is not really doing anything other than maybe setting the stage moving forward. So is it going to change my life? No. Is it really cool to watch? Yes.
Yeah. I'll fade just the topic. I mean, it's very cool. It's the furthest anybody's been from Earth. What I read was that we're scoping out a landing spot for the 2028 mission. It's been 57 years since we were on the moon. Like, let's get back, or let's go to Mars, or let's stop talking about it. So I'm gonna fade the mission. I mean, it must not be that important to be on the moon if we haven't gone back in 57 years.
I would agree with that.
So we'll see. We'll see in 2028 whether they land and we get another small step for mankind, or if it's a big step for mankind. But a lot to do between now and 2028. A lot to do in the next week or so before the next episode. That's the episode for today. Thank you all, and thank you for joining me again.
My pleasure. Love doing it.